It might be frightening to go into the stock market head first. Where do you start? If you're a self-directed investor, the thought of having to select every investment yourself can be deterring enough for you to put off starting. But you might want to start with exchange-traded funds or ETFs rather than merely concentrating on individual stocks. Welcome to the Money Bender. Subscribe and let's dive in. ETFs. Don't let the acronym throw you off. Whether you're a novice or seasoned investor, this three-letter investment product can add value to your portfolio. Are you curious and want to know more? Starting with a definition, ETFs are pools of money that many people can use to invest in a variety of securities, such as stocks, bonds, and commodities. When you invest in one ETF, you will be exposed to all of the underlying securities that fund holds, which may number in the hundreds. ETFs come in a variety of forms. ETFs that invest in assets like commodities or currencies can be a viable option for beginners looking for exposure to new or more complicated markets because they are simple to trade on the stock market. Many but not all ETFs have the key feature of typically being passively managed. This means that rather than having a portfolio manager choose particular stocks to buy and sell using their best judgment, they try to mimic the performance of a particular index. This might be accomplished by an ETF owning a selection of stocks from an index that it tracks, such as the Dow Jones Industrial Average. As an alternative, it might invest in stocks from a variety of businesses operating in a certain industry, such as biotechnology, to track it. On the stock exchange, ETFs can be exchanged just like equities. As a result of supply and demand, the price of an ETF share may vary above or below its net asset value (NAV) throughout the trading days, since ETFs are bought and sold continuously. ETFs and mutual funds have a few significant differences. Despite the fact that they both appear identical on the surface, they are both collections of securities that generally attract thousands of investors. Mutual funds, for instance, are frequently handled actively. Mutual funds only trade once a day, as opposed to the constant trading of ETFs. At the conclusion of each trading day, the NAV is used to determine the mutual fund pricing, which are set once every 24 hours. Mutual funds and exchange-traded funds (ETFs) are two different kinds of investment vehicles that let investors buy a variety of stocks, bonds, and other securities. Mutual funds are financial instruments that aggregate the funds of numerous individuals to buy stocks, bonds, and other kinds of securities. While mutual funds are bought and sold at the close of trading at their net asset value (NAV), exchange-traded funds (ETFs) are exchanged on stock exchanges, and their values fluctuate throughout the day based on supply and demand. Because they follow the performance of a particular index, ETFs are typically passive investments as opposed to mutual funds, which are bought and sold at their net asset value (NAV). Mutual funds and ETFs both provide diversified investment options, but their goals for investing are different. For instance, an ETF would be better suited if you want to trade frequently and pay lower fees, but mutual funds might be better suited if you prefer a portfolio manager to manage your investments. Who may purchase ETFs? All you need to buy an ETF is a brokerage account with a company that deals in ETF trading. Once your brokerage account has been opened successfully, you can buy ETFs by submitting a buy order using your brokerage's platform based on your specific investment objectives, time horizon, and risk tolerance. Which ETFs are available for investment? There are various ETF types. ETFs that invest in commodities or currencies are available as a vehicle for beginners seeking exposure to more specialized or advanced markets because they are readily traded on the stock market. Stock ETF. Stock ETFs monitor a specific collection of stocks. They might follow these stocks according to their index or sector. Since stocks are prone to market volatility, long-term investors may find them to be a desirable option because a longer investment horizon gives securities more time to recover should the market experience a regular fall. Bond ETF. For investors interested in fixed income investing, bonds ETFs may be appealing. This is due to the fact that they frequently distribute interest income from corporate, municipal, high-yield, and U.S. Treasury bonds. Although high-yield bonds offer greater interest rates due to increased risk with lower credit ratings, bonds are normally less dangerous than other investments. ETFs that invest in commodities include precious metals, food products, and natural resources. ETFs that track specific industries, such as biotechnology, healthcare, and energy, are known as sector or industry ETFs. Currency ETF. Investors can gain exposure to the foreign exchange market by using currency ETFs to track different currencies. Leveraged ETF. Compared to a standard ETF tracking the same index, leveraged ETFs seek to increase returns. You could decide to employ them as a short-term investment plan. When the underlying index is rising, they can offer substantial gains, but you run the danger of amplifying losses, making them a high-risk investment. Inverse ETFs, also referred to as short ETFs or bear ETFs, seek to profit from the collapse of the indices they follow. The inverse ETF rises at a similar rate as the underlying index falls. These short-term investments, like leveraged ETFs, have the potential to incur substantial losses if the market changes. The benefits and drawbacks of ETFs are the most crucial information in this work. Flexibility, diversification, cheaper costs, tax advantages, and tracking mistake are benefits. Lack of liquidity, bid-ask spread, tracking mistake, the possibility of fraud, high expense ratios, and a lack of personalization are drawbacks. Compared to single stocks, which only let you invest in one business, ETFs provide greater diversity. They also have less expensive prices, tax advantages, and tracking errors. ETFs may also have greater expense ratios than conventional mutual funds, which can lower investor returns. Before making an ETF investment, it is crucial to be aware of any potential drawbacks. How to assess ETFs? There are several ways to assess ETFs, including looking at all the elements we've described above, considering all associated fees, analyzing the portfolio setup, assessing the ETF's previous performance, and more. However, keep in mind that past performance does not always predict future performance. Investing goals. Review the prospectus, which you can get from the fund, for information on investing goals, risks, fees, and expenses. Its indexes as follows. Recognize the components of the index as well as the guidelines used in the selection and weighting of its securities. Duration. How long the fund has been in operation and, if possible, how both have fared in both good and bad time. Expense ratio. The smaller fees are expected to be, the simpler the investment strategy is and the more liquid the securities in the index are. An actively managed ETF, for instance, is probably going to have greater costs than one that just duplicates the S&P 500. Taxes. Returns may be taxed in a number of ways, depending on the investments the ETF makes and the structure of the ETF. For instance, the 28% maximum tax rate for collectibles will apply to an ETF that invests directly in gold bullion. Both long-term and short-term capital gains may be distributed by an ETF that utilizes futures contracts, as are many commodities ETFs. Interest received from a bond ETF is taxed as ordinary income. Investigate the management team's background and experience as well. If you want to determine whether an ETF is appropriate for your situation, you might want to think about speaking with an investment professional. They can point you in the direction of what will work best for your timetable and goals. You should thoroughly study and take into account the investment concerns, risks, fees, and expenditures of any ETF you are considering before making an investment. Once you have a firm understanding of exchange-traded funds, you can determine whether or not they are a good fit for your portfolio. Examining the diversification of your current portfolio is a smart place to start. From there, You can look at ETFs to fill in any gaps in the composition of your portfolio. When investing in ETFs for the first time, you can feel confident if you have a solid understanding of the principles you've studied here and your individual portfolio's requirements. Thank you for watching. Follow for more.